Hey all, welcome to ShareTreck. Today is Saturday, it's the 26th of February 2022, and today I want to talk about a general topic, which is risk assessment and how we can manage ourselves in this great times of volatility. So I hope you find this video interesting and it gives you some ideas if you already did not know about it, and helps you to manage your risk better and be a better, crisper investor. Let's get started. Why do we work and what's the meaning of life? This is a philosophical question and the answer will be different for different people. However, the underpinning physiological factors such as the need for shelter, sustenance, and belonging has a great deal of influence on the need to work for a better future, because we have upgraded from barter system to the monetary system where money is a store of value. And now we have a choice of working upfront and saving all those results in money and then spending the money later on in life. So that choice is there, and that in a way is called investing, saving, investing, and saving for a retirement or any other name that you would like to give. The uncertainty of life complicates estimating future needs. So let us say if one is 30 right now and they think they're going to live for 50 years, then live for another 50 years, that's up to the age of 80, then there needs to be savings that is adequate to provide for 50 years. So a 30-year-old may decide that I'm going to retire at 65. And so if they retire at 65, they have got another 15 years to live. So at that point of time, they need to have enough money so that all their living expenses and some unexpected expenses during the last 15 years of their life can be taken care of. And that's generally the most important objective of saving and investing. However, the fact that we don't know whether we're going to live for 80 years, 90 years, or maybe 110 years is what makes it very, very complicated to plan for the future. And that does have a bearing on a good outcome for life. Therefore, what we need to do in general is to start planning. Planning is very important. Planning is like drawing a map from where you are to your destination, making choices along the route, and each choice that you make has got its own risks and benefits. So you have to decide whether you're going to embrace the risk as cost of doing business, or you're going to avoid risk and take a different route, or if you're going to hedge the risk with insurance. So those kind of choices have to be made. But essentially planning is like drawing a map from where you are to where you want to be. And it's very important to plan because it helps you to visualize your objectives. It helps you to visualize the path to the objective and all the risks that are in the objectives, and mentally prepare you in advance for the choices that you might make on the way. So that's the importance of planning. Without planning, it's like you're heading into the wilderness without a map and a compass. With planning, it's like you're heading into the wilderness with a map and a compass. So you're assured that you're going to reach your destination regardless of all the things that are in your path. The other most important thing is the need for discipline. There are people who make plans and just put it into their drawers and forget about it. So it's very important that there is a discipline of sticking to the plans. So if you have a discipline of sticking to the plans, then there's a good chance that you'll have a very good outcome for your financial life. One of the ways in which plans drop off on the sideway is also because when there's a moment of crisis, like what is happening right now in the market, when the markets are very volatile, we tend to just throw away the plans and wing it, because our fear and our greed, everything takes over, and we just think that the plan is antiquated or it's not practical, and we just ditch the plan. That's very wrong. We need to stick to the plan, because what looked clear when the horizon was clear and the weather was clear is still going to be the same, even though there's a lot of clouds and storms and rains in the horizon. So sticking to the plan is very important, and discipline of sticking to plan is what helps you to have a successful outcome. Risk is the possibility of an unfavorable outcome happening. And risk is there in every part of our life. It's absolutely impossible to avoid risk at all. When you step out of your house to buy milk, you have a lot of risk that you're not going to come back home. But risk is the very nature of life is that it's full of risks. So we need to understand risk. Risk tolerance can be defined as a point where market volatility forces you to withdraw from the market. So That's your risk tolerance. For example, I may be holding a share of ARC-G or maybe CRISPR Therapeutics. So at what stage am I going to be tempted to just sell it because the price has gone too low? Let us say I bought it at $120 and the price falls all the way down to 30. Is that a time at which I'm just going to let it go? If the answer is yes, well, that is my risk tolerance. So it's better for us to be aware of our risk tolerance in advance of our investment so that we can manage the outcome much better. However, as I mentioned earlier, when the market starts being volatile, it creates a lot of special effects, and we succumb to it, and we do unplanned things and take rash decisions or knee-jerk reactions. That's when we find that we sold something and the next day the price shoots up and we are left behind. That happens to many of us, and it has happened to me very recently. So it's very important for us to understand risk and how we react to the risk. And there is also a very important need for us to understand risk tolerance versus risk capacity. Risk tolerance is your willingness to accept risk. It's also your ability to absorb impact of investment losses as you pursue higher gains. So that's what I would call as risk tolerance. And when we look at risk capacity, risk tolerance reflects your personality and your beliefs and your investment experience. Risk capacity varies with your age, income, and financial goals. So for example, I gave you the CRISPR example. I bought it at 120, let us say. And how much can I wait before I decide that I want to sell it off? How low can it fall? It also depends on how young I am. So if a person who is in his 30s decides to buy CRISPR, and it went down, he or she can hold on for a long period of time until it comes back up. So that's potentially one of the aspects of risk capacity. The other way I would explain that is if you got millions of dollars in your account, free and available for investing, and if you have just invested maybe $10,000 on CRISPR, you bought it at 120, even if it goes to $10 per share, it doesn't matter to you because it doesn't make any significant impact, so you can hold on. In case of my portfolio, which I discussed in my earlier video, you would see that I had Bank of Ireland as one of my holdings, and I've had it for almost a decade. Because when I bought Bank of Ireland, at that time I was living in Dublin, and Bank of Ireland is one of the biggest banks out there, and during the Celtic Tiger times it was doing very well. And subsequently there was a mortgage crisis and other things during the GFC. Bank of Ireland really dropped significantly, dropped in value almost 90% and more. At some point of time it was quoted in cents, I think 45 cents or something per share. I was very young at that time comparatively, so I decided to hold on to it, and since then it has picked up a lot of its value, but still it has got a long way to go, and I'm planning to hold it. So that's the risk capacity, and I could do that because it was not my entire portfolio. It was only a portion of my portfolio, and I could hold on to it, and it was a sound asset. It continues to be a sound asset. It's just a matter of time. So that's how I'll describe risk capacity. So you have to introspect and think what is your risk tolerance and your risk capacity. Let's take the case of two individuals in order to give you an idea of risk tolerance and risk capacity. Let us say there is a guy, Jack. He lives alone. He has no family or anything. He's a bachelor. He has no debts, has no dependents, and he has been holding a good job for a while and has got a pension, and he's on track to meet his savings goal for retirement, and he's already paid off his mortgage, and he has got some emergency funds to support 6 to 8 months of living expenses. So this is the profile of Jack. His next saving goal would be to travel around the world and see the world. And even if Jack has a lower risk tolerance, clearly he has got a high risk capacity because he has no immediate need to access funds. And if he chooses investments with high risk and high growth potential, he could easily put some of his risk capacity to work. So this is an example of how we look at risk tolerance and risk capacity. To give you another contrast, let us look at Bob. Bob is a risk-taking person by nature. And in his very young age itself, he started doing a lot of entrepreneurship. And he does not have any emergency savings because he has put his emergency savings along with whatever capital he had to start his own business. And he's the primary income earner in a family of 4. For him, his wife, and his 2 kids. And both of his kids will be heading off to university in the next 3 to 4 years. So he has to provide for their college tuition and living expenses and other things. Bob has paid down only 60% of his mortgage, and he has got some retirement savings. But with more financial obligations than Jack, Bob has got less money saved, and therefore his capacity for risk may be less, even though his personal tolerance for risk is high. So you have to look at Bob and Jack and decide where you are, or probably you are in between those two. You can always repair your risk profile and your risk tolerance with a plan, and that's the importance of having a plan. It's important to understand risk versus reward when it comes to various investment opportunities that we have. So I have put on a few of those opportunities here, which are available to retail investors. One is cash. You can keep all your money in cash, but the unfortunate problem out there is that when you hold cash, with inflation, the value of your cash is decreasing. However, if you decide to put it in bonds or in fixed deposits in banks or GICs, as they call in Canada, what happens is that the interest you get in most of these developed countries is maybe 1% or 1.2%, and it's not adequate because it goes away into taxation, and it's less than the rate of inflation. So it's no good for providing us with retirement income. So if your cost of living lifestyle is around $5,000 per month at current dollar rates, then imagine how much bonds you need to save in order to get that kind of return through investment post-tax. And if it was cash, then you need to have a whole lot of money in cash because it's not giving any interest, and you're just going to draw down on it. And none of us can afford to have that kind of a bank deposit to afford us retirement. So that brings me to the next option, which is annuities. Many financial institutions and insurance companies offer annuities. So you can pay a lump sum amount of, say, $100,000, and they would tell you how much they can pay you every month for the rest of your life. And there are various combinations in there about annuities, whether you want to start the annuity right away or you want to start the annuity after you reach the age of 65 and so on. So if you're interested in annuities, put it down in comment. I'll have a separate video for you later on that. But annuities give you a fixed return. So as inflation goes up and cost of living goes up, you'll continue to get the same amount of money from annuity year after year. Therefore, there's a good chance that the annuity will not meet your requirements towards the end of your life because the dollar keeps on depreciating, and the fixed annuity amount that you get every month is not going to change, but your consumer price index is going to keep on going up. Therefore, annuities have that drawback. Next, you can look at real estate income trusts or your own real estate, which you buy and give out on rent, or your principal residence for that matter. Here, the capital is relatively safe and provides decent returns. So in the first 4 of these that we have seen, cash, bonds, annuities, REITs, these are all relatively safer options with cash. Losing value to inflation, but there is no chance that you will lose the cash that you have because you have it in your hand. Bonds, the capital is very safe, but very low returns. With annuities, you have fixed returns, but there is loss due to inflation, as I explained. With real estate investment, you have 2 benefits. One is that your capital is relatively safe. Even if there is a real estate crash, your principal residence is important for you to live in. And people need food, clothing, and shelter. So whatever happens to the economy, whether it goes into depression or whatever, people will continue to need a place to live. So you can rent out accommodation and you're going to get rent. And rent is always linked to inflation and cost of living. Therefore, unlike annuities, rents and real estate investment has that advantage. The more riskier ones are stocks and venture capital. Stocks, the capital is not safe. There is a potential of very high returns, but there is also a potential of losing a lot of your capital. With venture capital, there is very high risk because you're getting started with a concept which is not yet proven, create an entire ecosystem, infrastructure, and a market for it, and then succeed. So capital is not safe, and the returns are very, very high. So when you talk about CRISPR stocks, basically you're acting like a venture capitalist, but you are just buying shares and it's in the open market, whereas actual venture capital ventures do not figure in the stock market. They are out there. There is also a new category of investment called SPACs, which is available in the stock market. SoFi was a SPAC before it got converted into a bank. So the big drawback with SPAC is you don't know which company they are going to take over and bring into the market. So that's why they are called a blank check company. So when you're buying SPAC stocks, when you're subscribing to IPO of SPACs or buying SPAC stocks on the NASDAQ exchange, what you're essentially doing is you're giving blank check to the guys who's managing the SPAC, that they can go and buy any new venture that they think is ready to be capitalized and put into the stock market. And once the venture succeeds and it is an IPO is bought out into the stock market, that's the point of time when you feel that your money can come back. There'll be a spurt in the market. You can cash out and sit back. So that's about SPACs, which is a new way of doing venture capital for retail investors. But otherwise, traditionally, venture capital is for people with a lot of deep pockets who can afford to lose millions of dollars if the venture didn't work out. So these are all the various opportunities that are available for a retail investor to invest. So here is the risk capacity assessment questionnaire. And the scoring is as follows. For any of the questions that are going to come up in the subsequent screens, if your answer is false, then you get only 1 point. If your answer is somewhat true, you get 2 points. If your answer is completely true, you get 3 points. So grab a piece of paper, grab a pen or a pencil, and start scoring your answer. Start putting a question there, question 1, what's your answer going to be, and so on. And at the end of it, what we want to do is total all the points that we got, and we'll see what it means. So let's get started. The first set of questions is 1. I can save money regularly? If your answer is yes, you know how many points you got to give it to yourself. Next question is, I can pay all my monthly bills on time, including any credit card or other debt and mortgage. So in other words, you're able to meet all your monthly commitments for your current lifestyle. And whether your current lifestyle is a valid lifestyle or not is a totally different discussion. We have to be rational about our lifestyle, and we have to live within our means. So I'll leave it at that. The third question is, I have enough income or other sources of wealth today to help me withstand any investment losses. So note down your answer for that. Ready? Let's go on. If I had to stop working for a year, my current lifestyle would not be impacted. Is that a yes answer for you? Is it a true answer for you? Or is it a false? Jot it down. If I lose money investing today, I have time to make up any losses before and will still be able to reach all my long-term saving goals. So in other words, if you lose, let us say you bought CRISPR Therapeutics at 120 and right now it's gone up to 40 and you can't afford to lose any more because you can't make it up, then that's the question we are asking here. If you lose money investing today, do you have enough time to make it up before you retire and still meet your long-term goals? So answer honestly whether it is true, false, or potentially true. Next question is, if I lose money investing today, my current lifestyle would not be impacted. Okay, let's go on next. I do not need to draw down more than 5% of my investment portfolio for any major financial goal in the next 5 years. In other words, you got everything set, you got all the things that you need, and you don't have to buy a boat or a car or anything, or send a kid to college or anything. For the next 5 years, you're all set. Is that the case? So put your answer there. So interpreting the score, right? Make a total. If you answered false to any of these questions, the impact of investment loss may be larger for you than for other people. So in other words, you should not have any answer that is false if you are an investor and you're taking risks. This means your risk capacity will be lower. The more question that you answer as true, the higher your risk capacity. And of course, this is only a general indicator of your financial ability to withstand investment losses. So you have to be honest while answering these questions. And then you have an idea of what is your risk capacity. So take some time, think through it, and that will get you more centered as an investor. So that brings me to the end of the session today. I hope you liked this session, and if you want to know more about annuities or anything else, or REITs or anything, please put in the comment below, and I'll definitely make a video on that and be back with you for it. So thanks for watching, and I hope you have a wonderful weekend, and I'll see you again tomorrow with another video. And if you're here for the first time, please consider subscribing. Bye for now.